Stocks jumped to record highs this week with economic reports firming up expectations of a Fed rate cut. Investors now betting the weakening job market will prompt Chairman Powell to deliver a quarter-point cut at this week's meeting. Joining me now is Richard Bernstein Advisors CEO Rich Bernstein. Thanks for being here, Rich. Good to see you again.
Jack, thanks for the invitation.
So when you launched your firm back in 2009, you were a lonely, bullish voice among all those pessimists. The S&P, I looked it up, is almost exactly 10 times higher than it was in March of that year. You still bullish?
Yeah, a little bit differently bullish, but yeah, still bullish. I mean, if you think back to 2009, investors were really under their desks in the fetal position. They didn't want to hear about how bullish the United States was. They didn't want to hear about U.S. stocks. You had to twist their arms to look at stocks, period. And if they were willing to look at stocks, they wanted emerging market stocks. And now here we are, 15, 16 years later, and what are you hearing about? American exceptionalism, right? That should have been the story 10 or 15 years ago. So I think we're still bullish, but we've broadened that bullish notion, to include more non-U.S. stocks in our mix as well.
Yeah, let's talk about that in a minute, but let's talk about the upcoming news. Next week, we expect that quarter-point rate cut. That seems to have gotten investors really excited, even though it's not really that big a surprise. Should they be so excited about this cut?
Well, I think it can go a number of different ways, right? I mean, excited can mean different things to different people. But I think if the Fed cuts rates and the reaction in the stock market is a broadening of the market, if small caps and mid caps start rallying and we see that, that would be a sign that the Fed rate cut is going to benefit the broad economy. And I would argue that's very healthy. However, if the reaction is that the Fed cuts rates and we see cryptocurrencies and the Magnificent Seven and meme stocks take off and it's just more and more speculation, I would argue that's not very healthy at all and might actually damage the economy, dare I say.
Yeah, we'll see what happens. I hope that equal-weighted ETF maybe does a little bit better. I want to ask about tariffs. There was expectation that that would spark inflation. Yeah, we've seen a little bit in groceries, maybe furniture, but nothing widespread. So who's actually paying for the tariffs?
Yeah, it's a very important question right now, Jack, because a lot of economists and a lot of investors, myself included, to be perfectly honest, thought that tariffs would result in immediate effect in prices. And what we saw was much more muted than what people thought. And so where did the tariffs go? Well, what happened was that a lot of companies tried to eat the tariffs. They didn't want to lose market share by raising prices, and so they cut their margins. As the tariffs went up, it ate into profit margins, and so now we're starting to see that in the weak employment reports, because what's happening is companies' profitability is under pressure, so now they're not hiring or maybe laying people off. So it's kind of a mixed bag as to what actually the reaction has been in the economy.
Another factor that could be eating into some hiring is AI. The question is, will it replace workers? Recently, we heard the Klarna CEO at the time of that IPO say he had managed to reduce headcount simply by not hiring. They went down from 7,000 to 3,000 employees, and AI is taking over that work. Is that widespread throughout the economy? And I guess, it's not good for workers, but could be good for stocks, right, if margins increase.
Right. Right. So, right now, a lot of those kind of AI replacements are really occurring in the tech sector, or what I would call the near tech sector, because that's where it's at. I don't think it's really broadened out. I don't think you're seeing like food companies or steel companies or something like that talking about AI replacing workers yet, although that may happen in the future, of course. But I think yeah, go ahead.
I realize we're almost out of time, and I do not want to leave without getting you to put a little bit more meat on the bones of your recommendations as to where you find opportunity right now. Sounds like foreign, and also what sort of U.S. stocks still look attractive, still look well priced.
Right. Well, I think if you're going to look at U.S. stocks, I think you want to look at dividends and value. If you think about what everybody's doing, everybody's become very speculative. We're looking at, people are looking at stocks under $5 a share. They've completely forgotten about dividends. But dividends are one of the easiest ways to build wealth through time. Since NASDAQ's inception in 1971, utility stocks have pretty much kept pace with NASDAQ. Amazing statistic, but it's pretty true.
Yeah, that is extraordinary. I don't think most people would guess that. Richard Bernstein, thank you so much. Good seeing you again.
Good seeing you. Thanks, Jack.